Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Jeff Taylor. He is the co-founder and managing partner over at Digital Risk. And we're going to focus on risks in the securitized loan market. Jeff, thank you very much for joining us at MarketSite today. Let's talk about strict compliance rules like TRID, TRID. They're necessary for the lending industry. Why is that?
So it's necessary because post-crisis, obviously, a lot of the data was incorrect. It's caused a lot of the issues in the securitization market. So now what you have is making sure that the data is actually correct. We know everything about the borrowers, so it's right, and also goes a long way to predicting how the loans are going to perform going forward. So it's very, very important in today's market.
So what does TRID stand for?
Truth in lending.
Truth in lending.
Yeah.
Okay, so that's what that is. Why have small business owners typically been shut out by mortgage providers?
I think it's been shut out. I think a small business owner, since the credit box got so small, everybody was looking for that W-2 consistent type of lending, where small business owners have different sources of income and it's more in pockets. So for them to actually be able to provide the right income for a loan might take a little more period of time, but I think they're getting right there now.
Well, the next question is, what about the gig economy? Because that's growing day in and day out. I would imagine that's a challenge for mortgage providers as well.
So actually that's really, really interesting, right? Because if you look at where we are now and going forward, people have income from like Airbnb, Uber, so versus traditional 1099 or W-2 income, the end investors are actually having to say, how do we consider all these other alternative sources of income to actually make a mortgage loan? So Fannie Mae actually started accepting Airbnb income recently, and from an investor perspective, when an investor says, we'll go ahead and accept that income, the lenders can follow suit lending towards those types of loans.
Tell us about disruption amongst due diligence firms.
So over the last 5-6 years, like everything else, firms either keep up with technology and customer service or they're going to fall behind. So we've actually seen a big lag where a couple of the large due diligence firms are no longer as dominant as they once were, and that's actually an area that we've really focused on, trying to bring a better experience to the marketplace.
How can large originators still use legacy systems like documentation and manual work, and how does digital risk fit into this?
That's a great question. So in a lot of the core systems or LOSs in our industry keeps all the borrower and pertinent data about them. It's very hard to spend all your money replacing a system, upgrading them. So we help our lenders do in business take that data out into what we call the intelligence layer, so it's more able to be monetized and acted on in a real-time basis versus having to spend a ton of money replacing core systems, and it makes a much more digital experience. Like for instance, Amazon and the way they Netflix, how great they are at personalizing things towards the consumers. That's kind of the final frontier for financial services companies, and that's a lot of what we're helping them do, is apply the data they have without having to have huge investments on the back end to get the better customer experience.
All right, well, thank you very much for joining us at MarketSite. Thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.